Hello, thank you for joining us for our annual update. My name is Kelley, and I am President and CEO of Family Capital Management. So where does Family Capital Management believe markets are heading going into 2024? With a presidential election in this year, and not a simple presidential election, there's a lot of complexities that are tied into that, but I don't want this whole discussion to be tied around politics, as I believe that politics have a very limited effect on markets. There's linear regression analysis that would support what I'm talking about, that the correlation between who's president and what happens in the stock market are not correlated, at least not over longer periods of time. You might have emotional trading volatility that takes place in a market based on who people think are going to be president. But at the end of the day, businesses get valued based on their profits. People buy businesses based on how much profitability is available in that company, what the outlook is for that industry, and how quickly they think they can pay off that business to start cash flowing and getting the benefits of being a business owner themselves. And in publicly traded companies, there's a lot of owners, so it makes it a little bit more complicated, which is why there's a lot more reporting that has to take place, 10K filings, and why there's an open exchange to trade shares of that company. So politics is kind of low on the priority list for my discussion today. However, I do know that it's high on other people's priority lists as they emotionally process what they think is going to happen in the market. Again, profitability is what I'm going to focus on. And there are things that I will do in a portfolio as a manager to make sure that I'm hedging volatility for risk-adjusted return reasons. So that's not to say that we wouldn't do anything as a result of having the election in 2024. However, statistically, I've ran an analysis back to the 1900s of every presidential election and what happened in the S&P 500 total return-wise during that year. And 82% of election years close positive. And even the ones that don't, you'd look back in those years and there are some pretty significant economic things that were taking place that you and I would say has nothing to do with who is president. You know, in fact, the president maybe just came in while all that was developing. So I think it's really interesting anyway that we do that in this country. We assign economic activity to who was sitting in the presidential seat at the time. I think that that's a little bit irrational. So where do I think profits are heading on these businesses, on the publicly traded stock and private business? Where do I think that's heading going into 2024 and beyond? I believe they're heading up, and there's multiple reasons for that. There's three key ways that you can increase your profit in a business. One is find new customers. Two is increase your prices. Three is cut your costs. Because profits, revenue minus cost equals profits. And all three of those right now are in favor of the marketplace. In 2022, when the Fed changed the interest rate from effectively almost 0 to 4, so they moved the interest rate 4% in 1 year upward, effectively that created a competition between stocks and banks that we haven't seen maybe since 15, 20 years ago. It also created, in simple terms, it created 5% CDs. It created 5% money markets. So what do then publicly traded companies who also want your money, what do they have to do return-wise so that everybody in America doesn't choose a CD or a money market? They have to up their return. And this goes back to risk-free rate theory and the capital asset pricing model. There's a lot of theories that are based upon this risk-free rate. So when that happened, this profitability came into big focus for publicly traded companies. We also have some huge demographical changes that are taking place, i.e. baby boomers leaving the workforce and millennials moving into the workforce. And if I were to ask people who they think the most populous generation is, they would tell me baby boomers, I think, more times than not. just by the sheer name, baby boomers. But really that's not true. Millennials are actually more populous than baby boomers were. And so we have, a problem would be is if we set our whole economy to baby boomers and then had a lesser populace coming in behind when we set our whole business models up to serve 79 million people, and now all of a sudden we're serving 55 million. That's effectively what happened in 2000 through 2011, is Gen X became our target market, consumer-wise and labor market-wise. If you have less people to sell to, it's pretty hard to maintain that profitability, and so the market has to readjust. So what's happening now? You have baby boomers who, through 40 years worth of work, have increased their salaries through CPI bumps and merit, and it's pretty significant cost that they're paid, especially in an S&P 500 company. And it's not just their salaries, it's bonuses, it's healthcare, it's payroll taxes. When a company eliminates one of these positions, they save about 40 to 50% because they can go purchase a millennial or give a Gen Xer a raise that's a lot less than what they would be paying the current baby boomer. It's also a point in time where they want to leave the workforce, but 40 years worth of habits makes it difficult. And you're at the highest point that you've ever been paid. You have some control over your time flexibility. It's an interesting phenomenon that's happening in our country right now. But I believe that it's for the better, at least as far as profitability goes. So if you're able to reduce your costs by bringing in less expensive units of labor, that should equal better profitability for companies. And that is underway, that is happening. Price increase, I talked about price being another one of those factors. Price increase is inflation. You've heard that word over and over and over again for the past 2 years, 3 years. And I wish they would just call it price increase, because that's what's taking place. And so if you're able to increase your prices while you're decreasing your costs, you would expect that to increase your profitability. And then what else did I just say? You have millennials who are more populous than baby boomers now moving into the workforce. And becoming your target labor and consumer market. So if you could kind of map this, we went from 75 million economy with baby boomers to 55 million, and now we're jumping up to 76 to 79 million people that we have to serve. So there's a huge demand wave that's coming through this country currently as we speak. So those three things I expect to push profitabilities in businesses up, and therefore it should make these businesses more valuable. If they're producing more cash, they should be more valuable. So profitability wise, I see markets, profitability is going up. I would tell you I see valuations on businesses going up, which means I generally think the stock market's going up. S&P 500 specifically is what I'm referring to in this discussion. And I'm not the only one. I've looked at multiple research reports, and I've seen anywhere they use a term in publicly traded markets called earnings per share, which is effectively profits. So when you hear EPS or earnings per share, they're saying profits. After our costs, here's our earnings that we can distribute to shareholders. So that estimate on the S&P 500 over the next 2 years is, I've seen the low end at 27%, I've seen the high end at 50%, and that's after readjusted guidance through 2022 and 2023, where most companies started to cite their guidance downward. So profitability is in favor of the marketplace. New customers are in favor of the marketplace with the millennial generation entering. Costs are in favor of the marketplace with baby boomers leaving, and price increase has already been accepted because of inflation. And you're also going to have that on the wage side. And you don't lose the baby boomer generation as spenders. They're just not going to be spending out of cash flow wealth. They're going to be spending out of their asset wealth, which is around $70 trillion. That's an interesting number. If I asked people what the debt in this country was, they can rattle off pretty quickly. If I asked them what the total asset in this country was, most people would probably look at me and go, well, I don't know. as of yesterday when I was looking at it, it was at $178 trillion in assets in just the United States. So that's a pretty large number, and a lot of that is in baby boomers' control. And that's not because baby boomers are evil, wealthy people. It's because wealth is a function of time. That's how this cycle works in the United States. You don't wake up. Most people don't wake up a millionaire. You work through the system, you work a job, and then over time, depending on how you manage your resources, you have wealth or you don't. So I don't want to get too off the beaten path. Where profits are going to be up, we think the market will be up. I do believe that the political environment will create high volatility in the marketplace. I also see forward to the discussion around tax code change. So when they initially implemented this more recent tax code, it had a sunset provision, and if Democrats and Republicans couldn't come to some kind of a consensus or put a permanent bill in place for the tax code, that it would sunset back to the old one with a couple of key changes, one being to the estate tax. I think that that's going to create the anticipation of that discussion happening next year on top of the presidential election will create a lot of volatility in the marketplace, especially when currently there is a safe place to put money. So again, I think that stocks are going to surprise people over the next couple of years. I also think that this is going to be a pretty volatile run this year. So if you have any questions, please contact me. Thank you for joining us.